Hi, everybody. I hope you're doing well today, and thank you for joining this webinar on cash flow management. My name is Meredith Medlin, and I'm happy that you've joined us today. I serve as the Director of Partnerships and Impact for Accion Opportunity Fund, a national nonprofit organization that provides affordable capital and business resources to entrepreneurs across the country with a focus on women, entrepreneurs of color, and those who've been locked out of traditional financing systems. But we know that financing is only one piece of a huge web of resources needed for small businesses to succeed. And that's why we work with partners to provide education, coaching, and networking opportunities to entrepreneurs as well. During such a difficult year, we are continually adapting our offerings to better serve the evolving needs of small businesses. Our team is very grateful to our partners at Start Small, Think Big for their commitment to small business as well. Today's webinar will provide you with a detailed overview of the critical processes and best practices you should follow to keep your business cash flow financially healthy. It's not always easy to foresee cash flow issues, and especially during a year like this one when revenues are all over the map, it's really vital to understand some core financial principles to help you survive and grow. Before we jump into our presentation, I want to quickly go over a few logistical items with you. I know we're all much more familiar with Zoom than we used to be, but just want to make sure that you can navigate all of today's features. So first, you should be able to see our presentation through the Zoom webinar tools window on your desktop if you've joined us by computer. You will see a chat function in the Zoom Windows black toolbar, so please locate that chat button and type in any questions you may have throughout the presentation into the chat box. I'll administer a question and answer session following our discussion based on the questions typed into that chat window. We are recording today's webinar, so you can refer back to this information at a later time. I will send an email containing a link to the recording shortly after the webinar concludes this afternoon. And last, just after this webinar concludes, we will be prompting you to complete a very short 2-minute survey to help us understand what you thought of today's presentation. We really value your feedback, so please do take just a couple of minutes to give us your thoughts about the webinar. And now I am very pleased to introduce my colleague, Ian McDermott from Start Small, Think Big. Ian brings years of valuable experience in financial management and workforce development to our conversation today, and his team at Start Small, Think Big offers a wealth of resources to small business owners. Thanks so much for being with us, Ian.
Thank you, Meredith. Very happy to be here and to be partnering with Accion Opportunity Fund. This is at least the second one I've done within recent time, and it's been a great partnership. We look forward to doing more as well. So I'm going to start off just with a very brief introduction about the organization before we get into core content. But I do want everyone to be aware that there are slides you can access on your own. So I've just pasted those into, or pasted that link into the chat. So it's a bit.ly link, bit.ly/uppercase SSTB, lowercase cash MGMT. So you can see those slides and follow along at your own pace, and feel free to post into the chat or Q&A any questions along the way, but we'll try to make time at the end. So Start Small, Think Big is a nonprofit. We're privately funded, and we have a number of services that we try to deliver directly to low to moderate income entrepreneurs. We are primarily headquartered in New York City and the Bay Area, but since the coronavirus, we've gone remote and are now pretty much serving anyone throughout the country. It depends for what issues you're looking for assistance with. Some of the legal program, which is one of our 3 programs, some of the services from that legal program would not be available to entrepreneurs in certain areas, just because we might not have legal volunteers with the expertise in your locality. If you need assistance from us and you're in some of these areas, you're unsure if you qualify as a low to moderate income, or you're unsure what stage your business is at, you should reach out to us anyway. We'll let you know if we can serve you or not. If we can serve you, we have this financial program, of which I'm the financial program manager, legal program, as mentioned, and the market access program. So we'll always try to deliver services one-on-one whenever possible. This is either through program staff like myself or our expert volunteers from different institutions and firms throughout the country. So today's workshop, we'll be focusing on the financial program. The program itself kind of touches on 5 different pillars. So along the top, we have these infrastructure pieces that you'll see in blue. This is financial management, where we're talking about separating business and personal finances, business banking, uh, point of sale systems and sales tax, if applicable. And then with those systems, kind of data collection, we want to put that all together. And that's where bookkeeping comes in. So with bookkeeping, we can discuss different systems that you're using, what other options there are for you, and how to use those in a way that's both meaningful and useful to you, not just tax person or accountant, tax filer. You want to make sure this information is meaningful and useful for you when you're looking at the financial statements, which are generated from these systems. So that'd be your profit and loss, balance sheet, cash flow statement. These all tell a different part of the story about your business, and you should be able to use them when telling your story. Once we have that kind of core data in a way that's easy to read and analyze, we can start doing kind of growth and strategy services. So that's down here in these lower buckets. We have financial projections, which is an exercise we're going to be talking about today. It's kind of the core exercise to do analysis and kind of running different scenarios. The idea of projections may make it sound like we're trying to predict the future, but that is not the case. We're just running out what might happen, and hopefully we can identify some floors and ceilings to kind of narrow your choices for what you should do with your business, and hopefully get you closer to your goals based on those kind of narrowed options and scenarios that we've run out in financial projections. What we might find in doing so is that you need additional capital. And that's when we can talk about different financing options, whether that's micro lenders like Accion Opportunity Fund, whether that's traditional lenders like your Main Street Bank, or equity investors. We can discuss what those different options are, and if you're a best match for anyone, or what you might need to prepare to present to one of these capital sources. So we will in today's workshop, kind of talk about those early infrastructure pieces very briefly, just to give you a general idea of what you should have and what will help you do the kind of analysis that you need for real cash flow management. There's not so much just quick, easy strategies to suggest every business follows. I will get into some of that, especially around the debt management later on. These kind of phrased strategies that some advisors may suggest. But what we really want to do is see what your business is doing and come up with a strategy that's particular to your situation, what your needs are, what your goals are, and what your business is actually bringing in. So to do that, we really need to make sure there's an income statement that you can project. We'll talk a little bit about that, as well as the cash flow statement, which shows additional information that we do want distinct from a traditional profit and loss statement. So if those are kind of new phrases to you, not sure what the distinction really is, we'll get into that, and how all of this actually allows you to better manage your finances. Once you have these systems set up and these goals and scenarios run out, you'll really be able to do a better job monitoring how the business is doing. So we'll talk about some kind of key metrics that you might want to look at, and other ways for you to track the success of the business. All right, so in financial management, as I mentioned before, separating the personal and the business is really an important first step. If you do have an LLC, that's going to be a critical part of limiting your liability as the business owner, distinct from the business. If a lawsuit or debt collection happens against the business, you don't want a judge to have to come look at your personal finances, seize assets, or garnish future wages. So you need to have finances that are actually distinct for this separate entity. A judge has to believe that these entities are operating separately, you, the individual, and the business as its own thing. If you don't have an LLC or a corporation, you're just a sole proprietor, you're self-employed, uh, there's still benefits to separating out those finances, at least by using a separate checking or savings account where all the business's sales get deposited, all the business's expenses get withdrawn from. Just makes it easier for you to see what's actually going on in the business. So regardless of what your entity type is, I would suggest separating out these finances, having one bank statement for one activity, one bank statement for another. Uh, when you do have a separate business bank account, and when you go talk to a bank and ask them for a business bank account, they might ask you to provide them with documentation that you actually own the rights to this name, that you're legally making transactions or agreements with the business's name. So in those cases, you might need things like operating agreement, articles of incorporation, depending on what your entity structure is. As a sole proprietor, you might find that the bank does not want to give you what they call their business bank account. Again, not a big deal if you're just a sole proprietor and there's no distinction between liability. You can just use their personal checking account, savings account. But if you're trying to get the name of your business on those checks so that you can send to vendors and it can increase the legitimacy of your business in the vendor's eyes, you may want to go through some of these additional steps so that the bank will put that business's name on your checks. A doing business as is another option. This goes by slightly different names in different states, but there are ways to kind of secure the name of a business regardless of what your entity type is. And of course, by having this separate bank statement, again, regardless of the entity, you'll be more easily able to do things like tax preparation instead of having an accountant or tax preparer call you and ask you which ones are business, which ones are personal transactions. You can send them over just one statement. We'll talk about in the next slide is a way to make it even easier, even cheaper for them. The other thing that's down here at the bottom is regarding sales tax. So a certificate of authority. Again, this language changes between different states. So in California, this is a seller's permit. But if you're selling taxable goods, right? So not just income tax, we're talking about sales tax based on the sales that you're making, what you're selling, to whom you're selling them. You may be required to register with that state to legally sell those taxable goods or services. So you should check that out because it may be a thing that a bank asks you about. If you tell them what your business does, regardless of whether they actually know the laws or not, they might ask you, shouldn't you have a seller's permit or certificate of authority? And you should have an answer to that, whether you should or not. So you can contact or look up your state's tax department and try to search for what your business actually sells and see if you are taxable or not, and if you need to register with one of those. So once you have this separated bank account, and one of the things you might look for when choosing a separate bank account is that it has a good online infrastructure. This means you can download data, you can, as a CSV file, right, where there's different points of data in a spreadsheet rather than just a PDF image. That can allow you to sync your bank account with other systems. What I would say most importantly is a bookkeeping system. So the ones down at the bottom here, Wave and QuickBooks, these are online, cloud-based digital bookkeeping systems that can allow you to automatically sync your bank account and have every transaction flow directly into the bookkeeping system. Bookkeeping is all about adding additional information to those core bank transactions. Just because you have a deposit in a checking account doesn't mean you necessarily have that amount in sales. Some of that amount that was deposited might have been sales tax. Maybe the entirety of the amount was a loan that you received or an investment that you personally made in starting up the business. That kind of detail is not going to show up automatically in a bank statement. So a bookkeeping system allows you to start categorizing that. And based on those categories, it will automatically generate those financial statements that we talked about and that we will talk about in more detail. And overall, this will allow you to start getting more insights about the business so that you can make more informed decisions. There will be occasions where you are surprised by how much you've spent or made on a certain category of income or expenses, and this will help you, again, just make better decisions. So in distinction from kind of older versions of QuickBooks, some of you might be familiar with the desktop version where you just plug in a CD and that specific device, a desktop or whatever you were using, had your books on it. Now, because they have these online systems, anytime you log into your account, whether that's from a public computer or your phone or a laptop, you'll be able to access the books as they were last edited, or if they're synced to other systems as they're last updated. So this will certainly save you time and peace of mind. It's not the occasion where if you drop your laptop or you drop your handwritten books or folders of receipts that you've now lost all your business history. This is all there somewhere on the cloud. They can also help you automate repetitive tasks. There's a bit of AI in both of these systems that will learn how you use it and can do a lot of cleanup work very quickly, and future work might do it for you altogether. So QuickBooks, I'll just mention quickly, has an online monthly subscription. So you'd have to pay for it monthly to use. Wave is free in terms of its basic core features, things we talked about today. But if you did want to, let's say, accept payments or use additional add-on features, they would charge for some of those. So if you're unsure of what bookkeeping to do, you can always just start with a free one and then add on either one-by-one services or start paying for subscriptions if you know you're going to be getting some value out of those other systems. So a couple of pieces of vocabulary that I want to talk about as we get into the actual financial projections, and in particular your income statement, are expenses. So I'm going to use this phrasing a lot today. Cost of goods sold as distinct from operating expenses. Now, these are both expenses, so they reduce your taxable income. They show up on an income statement, or tying both of those together, the profit and loss statement that you file for income taxes, which is called your Schedule C, it'll be both of these sections will be on there. The difference between cost of goods sold and operating expenses is essentially the frequency in which these expenses occur for your business. Cost of goods sold are directly tied to the sales that you make. So if you sell a certain product, there's materials, packaging, maybe ingredients that go directly into the sale of that good, or in some other cases might be services, which you might still see cost of goods sold on the Schedule C profit and loss statement, but it's really just referring to cost of revenue. In those cases, still same idea. Is this cost multiplying with each sale? So the example of, let's say, a car company, if they have the rubber that goes on the tire, the glass goes in the windshield, paint that goes on the car, those things they have to pay for an amount of them based on the amount they produce for sale. Other issues or other expenses that do not multiply with the sales are operating expenses. These things might be the equipment or materials that are used to put the rubber on the tire, to put the tire on the wheel, to put any of the equipment or kind of cleaning equipment that staff might use, tools staff might use. Those things are not multiplying with every new sale. They might use the same piece of equipment or tool for 10 years. Of course, that's going to change based on what the business is, the longevity of the piece of equipment, but it's not multiplying with each sale, so it's not a cost of goods sold. All right, so that general distinction is going to be really helpful when we start trying to narrow down which pieces of the story you either need to focus on to come up with a good cash flow strategy, or to tell your story to a potential lender or investor. Since we've broken that down, we can now start talking about projections. Projections are the core exercise that you're going to do, you might do 20 different versions of financial projections. So I do have another link in here if you'd like to access an actual spreadsheet template where you can start plugging in your business's numbers. I have screenshots throughout the next few slides that will kind of walk you through an example of how to use that. We're not going to spend a ton of time going over the details of how to use a spreadsheet, but I do want to stress what each component of that is trying to show you and ultimately what these result in. So when we do projections, the first thing that anyone's trying to identify is if the business is making sales greater than those sales cost, right? So that's essentially per unit economics or unit economics and profitability or pricing. So we're talking about gross profitability there when we're talking about the individual unit, right? So that would be essentially your cost of goods sold, your cost of goods sold subtracted from your price per unit. The gross profit we'll talk about in a little more detail when we look at the income statement. But if that is negative, if you are not selling each individual unit, whether that's a service or a good, for more than that individual sale costs, your business can never make money. So that would be an important first thing to check off the list and say, okay, this is at least not a problem. There's some gross profit here every time I sell this unit. After that, we want to look at the entire business. So there is a first step of including operating expenses, and that would identify net income. After you subtract operating expenses from gross profit, you see what the net income is. Now, if that is negative, you're going to need to increase sales volume by some degree until you essentially break even. If you break even, you have a positive net profit. Your business and net profit and net income are used interchangeably as synonyms. So if you hear me switching between those, talking about the same thing, expenses minus income. If you have positive net profit, net income, your business is breaking even, it's covering its own costs. That is still not enough to determine if you have enough cash flow. And that's what we'll walk into in a couple of slides. What happens after net income is essentially what the cash flow statement shows. And in that, you might want to see both what is the goal number of sales you need to make, or how much runway do you have, right? Is there an amount of time that the cash you currently have is likely to run out in? And if that's the case, that may require you to, of course, find additional capital to try to change expenses. In the meantime, we'll walk through those different considerations as well. General steps here, we'll walk through each one of these again pretty quickly, but the general steps are first identifying what are your actual sales units. Then what are those variable costs, the things that multiply by each of those sales. So variable cost, again, a synonym for cost of goods sold, cost of revenue, or direct costs. And then your total outflows. So we need both the operating expenses as well as whatever else you're paying for, which might be repaying loans, paying yourself, paying for personal expenses. These things aren't typically shown in an income statement, but they are important for you to figure out if you can keep running the business or what needs to change for you to keep running the business. And then the last thing is going to be tied into this also last bullet point is iterating or changing the projections based on things like your limitations, right? You might come up with a sales goal of 1,000 units a month, but realize that that takes way more time than you'd ever be able to actually facilitate. So you would need to consider those things and then change projections based on that. Your benchmarks might tell you, well, last November we were able to sell this amount, so let's at least start there and see what we can do above that, right? Now, breaking down each of these steps, again, this is essentially the same format you'll see on that template. It is first a table of what your units are. So if you're a product or food business, you might be selling chocolate chip cookies. Not every chocolate chip cookie business is going to sell one cookie per unit. You might have a package that has 2 cookies in it. So that's your sales unit. Whatever your sales units are just needs to be meaningful to you. So if we were to say you need to increase sales by 10 units per week, you should know exactly what you're talking about. You can customize this based on how your business actually operates and how you think and plan about your business. And then we need a price that you have charged for that. Again, these will go through iterations. So if you're doing pricing models, you'll change that in another example. Muffins, if you have just one per package, a little more straightforward, you have a price there. Now, for service businesses, they might have a difficult time figuring out what these projectable sales units are. Similarly, for food businesses that don't sell a product, but instead do some kind of catering or customized work, you might also be struggling with this, how to identify what this menu is. And the easiest way to do that is to just use whatever your past sales were. If you know you've done a job for this price that involved these costs, that's what your projectable sales unit is. So you can, of course, always do by hour. If you know a certain job is going to take you a certain amount of time and you're going to charge per hour there, that's easy enough to include as a sales unit. But you could also have this based on the entirety of a job, which would say, and maybe you have 3 different tiers of what those jobs are based on more complicated ones, more expensive ones, more affordable, or in your mind, profitable jobs. You might have 3 different tiers, different names. It's just telling you what these different jobs are. You can come up with, names to share with partners later on. When you're doing this work, you just need to know what you're referring to. Once you have these sales units identified, then it comes to the variable costs. Now, again, distinguishing between kind of more standard product-based businesses or service-based businesses where there's a little more customization, the question is just what gets multiplied by each sale. Now, if service-based businesses that are just doing consultations, you still might have some cost every time you make that sale. If you're traveling and taking an Uber every time you go meet with a customer, that you can include as a variable cost because it's going to multiply with every sale. If you don't have sales, you won't pay for Uber. Same thing if you're doing payment processing. Whether that's through PayPal or Square or anyone else. If they're taking 3% of every dollar that goes through their system, you can include that as a variable cost so that you can more accurately see how much you're going to pay for that after some volume of sales. In the product-based business, a little more straightforward, what goes into this product. But again, we're tying this to sales units. So you would want to see not just how much a packet of granulated sugar costs at the store, but how much of that packet you're actually using in a $2.50 package of chocolate chip cookies and what that cost is per unit. All right, so there's a number of different ways you can come up with these kind of calculations. And the spreadsheet that we share is where you can essentially put these things in. There's also going to be white space where you can kind of make notes and do separate calculations. So feel free to do that. After we have variable costs, right? Oh, and sorry, let me just summarize again. The direct costs subtracted from that per unit price is going to give you a gross profit. That gross profit is also referred to as a contribution margin. So that's what you'll see there. Try to throw a bunch of different synonyms at you so you'll hear them. This gross profit is what's essentially going to be multiplied by some volume of sales to see if you can cover the rest of the expenses. And our spreadsheet does have a little percentage there, so you can see what's more often referred to as the margin. When someone just asks you what's your business's margins, if they're asking about gross margins, that would essentially be right here, right? This 61%. Operating expenses are more straightforward. If you have regular operations, you know what you're paying for every month or every so often. These might be subscriptions, utilities that you're paying some vendor on a monthly basis. Maybe they're getting auto drawn from your account. Not all operating expenses are going to be like that, right? So in our spreadsheet, we distinguish between those as recurring expenses, which are essentially monthly, and you would include those on a monthly basis. What are you paying? And then these non-monthly expenses, which are essentially one time. They might be recurring for some period, but they're not every month, right? So maybe during the winter months, you're doing some additional marketing because sales are slow. So you want to put in some budget, right? This is an opportunity for you to say, I want to make sure at least have $50 a month to spend on advertising and marketing. So it doesn't have to just be based on your historicals, can be based on what you're planning on spending. And you might also know that at the end of each year, you got to pay, some market to do the holiday pop-up shop or anything like that. Insurance, again, you can always budget this stuff if it's helpful to you to see what this actually looks like on a monthly basis instead of annually. Totally up to you. Again, we're trying to plan for your business to be able to pay for these things at some point. If it's easier to look at on a monthly basis than annually, it's totally up to you. Now, moving on, now that we've got the actual costs into the projections, the next question is just how do we cover those costs? So if you're totally uncertain about what your sales volume should be, or you're just doing essentially trial and error, it's a very useful way to do this because we essentially need to identify what a sales goal should be. So if we start off with some number of units each month, if we're just looking at the chocolate chip cookies, we say, well, what would it look like if we sold 100, 150, 200, and so on. Now, if you had multiple units, this total units sold would be adding all of those up, but we just have one row of sales units. We are including some volume of sales. Now, again, if you have benchmarks from historical sales, if you know what you sold last September and you want to start there, great. If you know not only what you sold in past years, but what your growth rate has been since then, if you know you're increasing at a 10% rate of sales each month, great. Go ahead and include that and expand that out for however long you think is reasonable. Again, we're always going to come back and revise this information, both after we've identified what the goals need to be, and then based on what your actual activity is showing you, which might include more expenses, fewer sales, whatever else the economy might be telling you, you need to consider. So you might end up with multiple sets of financial projections. Might have one that's a low sales scenario, another that's a likely one, another that's a best case scenario. Even Fortune 500 companies come up with multiple sets of projections when they're making their either predictions or their estimates for what's going to happen in the future for them. So more data you have, more accurate you can get on these predictions or forecasting. But early on, you're just going to put in goals and revise over time. Now, once you have that volume in, that's essentially the precipice of, or the point at which the projections actually occur, right? We've now put something in here to affect those prices and units and unit costs. So that 100 units that we started off the first month with, and then 150 units, 200, 250, 300. Those units are going to multiply by price, and that's going to tell us what the revenue is. And so there's your fifth step. Your sixth step is multiplying that same volume of units in that September month by now the cost of goods sold, which for those cookies were 97 cents per unit. And the same thing, you do it with the increase volume over each month. Now, when you subtract that revenue, right, this 250, I'm sorry, when you subtract from that 250, the 97 of variable costs for that September month, that's when you're left with a gross profit. And that gross profit then has fixed costs or operating expenses subtracted from it, and that's what leaves you with a net income. In our spreadsheet, a parentheses would indicate a negative number. So you would know that by the end of this, September, October, November, and December all have losses. The only month that breaks even is January, right? When January has 459 of revenue, 459 of gross profit, which we saw here, minus $302 fixed cost, we have a net income, a positive profit of $157. So that's essentially your break-even month. And that break-even month required 300 units sold, right? We had 300 in the cost of goods example, and we had 300 in the price per unit sample, or your revenue example. So on an entire income statement spreadsheet, you would see this information as revenue minus cost of goods sold equals gross profit. And then that gross profit, having operating expenses subtracted from it, leaves you with net income. And this really tells you, did the business bring in more money than it spent in this period of time? The only point at which you actually break even here is January. That means you've got losses for September through December. This is not the entirety of the picture, right? Because at this point, we might say, if I lost $98, I don't have any more money to invest back in the business. I would have to close up in September. Well, that's what we'll talk about in the cash flow statement. But this is an important first step to at least identify, is the business covering its own costs based on some sales volume? That is breaking even. All right. In general, this income statement is a super important document for you to be able to look at, be able to share, talk about, because it shows that core business activity. It's always going to be roughly the same structure, where it has three sections. So revenue, expenses are broken down by cost of goods sold and operating expenses. And then when it subtracts those expenses from that revenue, you're left with that net income. The smaller levels of detail that you get in here are essentially these categories of either revenue. You might have different types of sales. Maybe you have product sales and service sales. It's all great. Still going to get added up to some total of revenue. Your expenses, this is what we've been distinguishing since earlier slides. Cost of goods sold is the first thing that comes up. And it's because this is really the centerpiece of your business. If you are selling $7,700 worth of bakery goods as New York City Bakery Company, you need to know how much those specific sales cost under any set of circumstances. And that's going to be based on things like materials and ingredients. If you have to use a commercial kitchen for every hour of production, that's going to multiply with every bit of sales. And that total, your total cost of goods sold, is now a direct proportion to your sales, or is now indirect proportion to your sales. So if you double your sales, if we go from 7,700 up to 1,400, we know we've got to double the cost of goods sold. So that 1,400 doubled, increasing sales by 100%. We'd increase this also by 100%. So we'd have 6,000 in cost of goods sold minus 1,400, or subtracted from the 1,400. That doesn't tell the whole picture of the business. Now, sometimes, especially businesses like this bakery business, they might think that's it, right? If I sell a cupcake for $2.50, I know that the costs of making that cupcake are only 97 cents. But in this example, that left us with a gross profit of 4,700. What's not being considered are other things that the business needs to pay for to just be able to continue operating. And that might be storage, might be some examples of you interacting with your market, right? So getting online, actually doing marketing, letting them know you're there, whether that's online or in person, and insurance, so you don't get sued, or at least you can cover yourself if you do get sued, and that the state doesn't come after you with your license. So in reality, that 4,700 of gross profit, which is a very important number to know, is still not bringing in all that much money. It's actually only a total net profit of $230. So this is essentially the business's taxable income. This is what a pass-through business, if you're a sole proprietor, self-employed, single member LLC, When you file your individual taxes, you'll file a Schedule C that essentially has this, and this number passes through to your personal individual tax filings. That's the income you made from your business. Now, when you find this out, this information that might be too low, you might start saying, I need to run different scenarios. I don't want to end up with $230 of profit. I'm hoping to end up with much more. There's a number of different things that you can consider. I don't expect anyone to see this and immediately know what to do, but I just want to quickly identify things that you might run in your projections. You might first do just a price test, right? So with that price test, you first figured out the 250 of sales. When you subtract the total ingredients, leave you with $1.50 of gross profit. If you know that you have to pay for $2,000 worth of fixed costs, when you divide that $2,000 by $1.50, you would find that you would need to make 1,300 sales. Maybe that 1,300 sales in the period where you need to pay for $2,000 for expenses, like a month, is not reasonable for you. So maybe you do another price test, right? And you change the prices here, you have another set of projections, and you find that it's some lower volume. You also might have some goal in mind because someone's told you, oh, a food business, you should have your cost of goods sold, your cost of goods should be no more than 30%. Well, once you figure out what your actual costs are, you can then do a simple equation here where if your costs are, let's say $1, you can divide that by 0.3, which is this cost of goods sold goal, and then you would find what your price should be. So if that's the $3.33 instead of the $2.50, now when you do this break even, figuring out how many units you need to cover those fixed costs, that's when you would find lower volume needed, and maybe you want to go see if you can make 850 sales at this $3.35 rather than the 1,300 sales at $2.50. Right? These are different options. Your business might be more able to do this than this, but it's totally up to you. Some other options are essentially getting your prices as low as possible to try to essentially enter the market, right? So penetration pricing, this is often referred to as revenue maximization. The next slide kind of goes into a little more detail about this. This, you might just want to figure out what's the lowest that I can get to based on some reasonable volume sales. It still allows me to cover my units, cover my fixed costs. And when you find that out, you can compare that to some other price, right? Maybe this price involves you being able to pay contractors at some point. Maybe for every sale a contractor makes, you're going to pay them 30%. So you want to include that as a part of your pricing. Maybe you're not doing that right now, but you want to be able to do it later on. So you at least want to do the projections, see what it would look like, and see if this price is allowing you to get to that next stage. All right. So in general, with pricing, two considerations are to either increase prices or lower the prices. When you're talking about increasing the prices, the ceiling is essentially just a question of what will people pay. At some point, people will not pay for your goods because the price is too high. At some point before that, people might not buy enough of your goods, that the volume of sales might be too low to make it worthwhile for you. The only thing that you can really do about that is essentially test the market. Now, you might be able to send out a survey and get responses, and people will tell you, I think I would pay for this, pay this price for this product. But that's never going to be as certain as actually getting the sales. Same thing as, selling to family and friends, never going to be as definitive as trying to sell to the general market. Now, while I don't want to get into too much detail, there is this kind of economic discussion, or that for those who've gone to economics classes, price elasticity, which is also referred to as price sensitivity. So if the volume at which people purchase your service or good is tied to the price, meaning that if you lower the price, people will purchase from you more often. That's referred to as price sensitive or price elastic. That is what most small businesses sell. Price inelastic goods are typically things like gasoline, right? If you're filling up your car, you need to drive to work. It doesn't matter if they raise the prices on you or lower the prices, you still got to pay for the same amount of gas. Might change a little things in the general economy, but it's less sensitive than other products. So you need to be aware of that, and you need to be responsive to that. If you're not making enough sales, pricing might be a thing that changes what those sales do. It of course won't save a business that's selling a product that people don't want. So there's tons of others considerations to make there, but it should be a part of your toolkit, at least in doing projections. Now, in terms of lowering prices, again, we mentioned these different considerations trying to get into the market. And if people are sensitive to pricing because you're offering a lower price, they'll buy more of that. That can be a really good way for you to get a piece of market share, to essentially make a name for yourself in the business, that when people are buying this type of product, they are getting it through you. And that can be an important thing for growth later on. But this does essentially create a race to the bottom. So if you really make a headway in the market and are beating out larger competitors because you're selling at a price lower than they are, very large companies can always beat smaller companies on margins, right? They can purchase the supply chain. They can sell things that bring in losses for them if they sell other things that bring in profits for them. This might not be a long-term strategy for you to make a living on if you're competing against very large businesses that can lower their prices much more than you can. So it's something to consider. The other consideration in terms of lowering your prices is that you do want at some point to be able to potentially, or to at least consider, giving a discount, whether that's for holiday sales or if it's because you're short on money, you had some additional expenses come up and you're trying to just bring in as much revenue as you can to pay lenders, to pay vendors, whatever it is. You might want that additional room to make discounts when possible. So before getting into the actual cash flow slides, so yes, I saw a question about the slides. Those are available there, and we can send them along afterwards to anyone who registered. So in terms of cash flow, so far we've just been talking about your actual business expenses, business operations. That essentially ends at the income statement, right? The net income. Just quickly want to show the actual location of net income. This is considered the bottom line of your financial statement, of your profit and loss statement, otherwise known as your income statement. That bottom line of your P&L, the profit and loss, becomes the top line in your cash flow statement, right? So that's the same numbers that we saw for each month it looks like the years are inconsistent here. This is still the same data from the earlier slide. So the net income that we saw at the bottom of the profit and loss statement were these same numbers. Now the question is, what happens after net income? Well, in that first month, when we lost $99, the business had to spend $99 more than it brought in. We were able to stay open because the owner had made an investment of $1,000 to open up the business. All right, so that $1,000 then has the $99 of losses subtracted from it. And now there's an ending cash balance of $901, right? And this keeps happening. There's losses for these months. And we're getting down in December to this, almost to zero, right? $274 left in the business bank account. Now, we were able to finally break even come January, and we're able to break even for months following. So we start adding to that cash balance, right? Pretty simple idea here. It's just that these things are broken up into different financial statements, right? There's different language referring to these things. There's nothing super complex about what business finance is. It's just that there's a little bit of language that you need to be aware of, and a little bit of formatting to how these stories are told. But it's really just very simple ideas, just done all at once, essentially. So in this case, we know that the $1,000 was enough of a runway for this business to sustain losses for 4 months. Now, this might be an important thing for you. If you received the economic injury disaster loan, you now have some amount of money that you have to last for some period of time. At which point are you going to run out of money? That's an important question that you need to be aware of. So you need to do projections to see how much you're spending, and then to see, based on that, if things were to continue, how much time do you have before you need to figure out something else. So general idea of a cash flow statement there. That's what you'll see in our projections template as well. Cash flow statement similar to an income statement in that it's got these sections that you will see on every cash flow statement. So every time you see one, you'll see one that says cash from operations, cash from investing, and cash from financing. Now, as we mentioned, the net income, which is essentially the entirety of the profit and loss statement, right? We generally think of this as like a old ancient Egyptian scroll. Up at the top, you've got sales, then cost of goods sold, then operating expenses, then net income. Now, the cash flow statements, essentially, as you scroll down that, right? What happens afterwards. So this is starting right at that net income, but there might be additional things to consider. Maybe you only had $3,000 of cost of goods sold, but there's a bunch of those cost of goods that you've not yet sold. Maybe that's inventory. So there's actually another $400 of inventory that you paid for last year, even though it doesn't show up in your cost of goods actually sold. So in that case, when we're looking at this cash from core operations, right? What did the business actually use and do? In that case, we then find the business actually lost money in terms of operations, right? That extra inventory was purchased. Now, the next question might be, maybe next year I spend $170 less on inventory. And this will allow me to essentially break even in terms of cash flow or cash from operations. Might be any number of considerations here, but we did not sell this $400 of inventory that we purchased. So that can be a useful thing when planning for the future. Investing and financing can be confusing, that these are two different sections. The investing that we're talking about here is essentially the business investing in its future, right? So if you're purchasing large pieces of equipment that would skip expenses and go into assets, this could be real estate or machinery, buildings, whatever else you're paying for. That's not a typical yearly expense. You might put those in here. They tell a different story than the profit and loss statement, right? You're not going to need to buy a building every year, but it took a lot of cash for you to do so. Same thing if you're a bakery business and you purchase an oven, or if you sell an oven 1 year just because you got through with using it, you don't want to consider that part of your regular sales, because it's not going to happen again next year. You're not in the business of selling ovens. You just sold one year. So that might show up here. And then financing is really what we think about with in terms of like investments that you are making from your personal funds into the business, or that a bank or an equity investor is making into the business. All of those things would show up here, whether you've deposited money into the business or you've withdrawn money from the business. So as mentioned, in that first month, the owner put in $1,000. So even though there's negative cash flows in this operations section, when we subtract that from that owner's investment, we see $830. So again, just because you have positive cash flow, it doesn't necessarily mean the business is doing well. And these still might need different considerations. So it's really important to distinguish these things: cash flow from profit and loss. All right, all this does fit together. And I know I'm taking a little too much time, but you can see all this, every section that we've talked about from the profit and loss statement to the cash flow statement. It does show up. It's all the same information. It all does make sense. You just got to see what it means for your business, and it'll stand out in a little more detail. A couple of things that I talked about in terms of like debt management. If you have debt, you're trying to figure out how to pay it down. You need to first figure out what types of debt you have. So if you have different sources of debt with different rates, there's might be a benefit to you essentially paying the highest rate off first, right? So you're not spending additional money on that interest or the APY, right? Which would be the APR compounded. APR just means interest plus everything else. So maybe if there's different rates, you want to highest first. If there are similar rates, but there's a lot of different sources, you might want to choose to pay off the smallest one first, just so there's fewer lenders you have, right? You can then just deal directly with a smaller number of lenders. The kind of last strategy there is the snowflake strategy, which is essentially figuring out what your budget is, how much can you afford to pay into loans, and as you make more money, you're still just giving everything you can based on that budget. I'm sorry, above that budget. The budget should be what you need to pay for the rest of your expenses, and then paying down the loan with any additional funds that you have. All right. I also have a slide in here talking in general about refinancing. If you're running out of time to pay someone back, first thing, always talk to the lender. You do not want to get into a situation where you're considering bankruptcy if you've not yet talked to the lender. There are things that many lenders have, which are called like hardship plans. Many of you might be experiencing that right now. Some of the things that can trigger these hardship plans that can lower rates, extend the amount of time you have to pay them back, right? So deferment or rate reduction might be options. Other options, which are less direct with that specific lender, but consolidating, transferring balances. It's often done with credit cards. You move the higher balances to the lower balances. Generally okay. You can look into the difference between credit utilization, right? As long as you're not using all of the credit that's available to you, it's not necessarily a bad thing to have credit available. Talk to CDFIs, micro lenders, credit unions. They are generally there to help those who might otherwise struggle to get capital through traditional means. Yeah, I'll skip through this because it's kind of more basic information about that. One thing I do want to make note of, just because it's fairly new, is this merchant cash advances. So if you're using PayPal or QuickBooks or Square, and they said you're qualified for their loans, you need to just be aware that these things auto draw out of your sales. So if they have 10%, if they're going to take 10% of your sales every week, you need to first make sure that you can afford 10% of your sales coming out of the business. Some businesses don't have 10% profit margins. And if that's the case, after they take money back, you're not going to be able to pay your vendors or whatever your expenses are. So need to be aware of that. They're great sources of capital if you really need it, but they have kind of tough terms to do planning around, especially if you're not sure what your sales are going to look like. All right. And then the last thing that we ended with is just some different things that you want to consider for how the business is doing. All right. So growing is a great thing, but if your expenses are growing at the same rate as your sales, might be tough for you to actually benefit from it, right? You might just be adding on additional work. That's why scaling the business, trying to figure out a way for you to make more profit when you add more work is generally what you are going to want to look to see. So, right, maybe you're paying back some loans that allowed you to get there. Maybe you're paying back investors. Maybe you're growing the business with this difference between revenue and expenses, allowing you to get into new things that you want to be doing. Debt can be very helpful. You just need to be aware of why you're getting into it, be able to tell a story of why you might have more debt than assets. If someone's going to lend to you, generally not a good thing, but A construction business might be more likely to have a greater debt to assets ratio than, let's say, a bakery business, right? Because they need to purchase a whole bunch of equipment or whatever else in between sales. We didn't really talk about equity today, but it's another thing that people will consider when you're trying to access capital is are you able to get people to buy in terms of believing in the future of your business without a guarantee, right? That's how equity is essentially distributed, or are the only ways you're able to get capital through loans. Just tells a different story. And again, you want to be able to answer these questions over time. All right. So, and sorry, I know I ran a little long. These things you're just going to look back and forth at. There's nothing particularly new there. It's just the projections going back and forth. All right.
All right.
And I should mention, yeah, there's a whole bunch of details about the organization you can find in our slides and additional workshops as well.
Awesome. Thank you so much, Ian. It's just fantastic, all the work that Start Small, Think Big has done to support businesses during this time. And I can't thank you enough for walking us through all of these particulars around projections and managing all of these finances. It's so helpful. And I know that our audience is really excited about these topics and getting this really in-depth information. So I also want to share with our folks that are joining that we have a couple more conversations, presentations coming up around topics that are similar to this. So I'm going to drop some links in the chat. On November 17th, there's going to be a presentation with Start Small, Think Big around debt management specifically. So some of those things that Ian was touching on at the end of this presentation, continue that conversation. And then later on December 2nd, Accion Opportunity Fund is going to host a webinar around budget planning for the new year. So you can sign up for those webinars with the links that are in the chat if those are of interest. And I definitely encourage you all to pop some questions in. We're going to have just a couple of minutes to answer the questions that are already in the chat, and feel free to add more to those as time allows for you. So Ian, we have just a couple of questions that have already been left in the chat. The first one is, do you have any suggestions or recommendations on softwares folks could use for projections if they don't want to use a spreadsheet?
So I don't, unfortunately. The QuickBooks has tried at different times to kind of beta test different projections, but it's really such a unique thing to your business, right? The spreadsheets give you that opportunity to change information around, let's say, the volume versus the actual units that you're comparing. Even if you do have like an HTML version that you type into a website, it's still going to have the same core functionality as a spreadsheet. There's really just no way to get around this idea of you need to put in this data into this place for it to project. So, so I know it might be overwhelming looking at a spreadsheet with a bunch of different tabs, but if you just pick the few different things that we talked about today, those few different steps, you really don't even need a spreadsheet. You can do that on your calculator. It's just a few different steps. There's just different ways to format it, right?
Yeah, I think that makes a lot of sense. You want to make sure that it's customized for your actual situation, for sure. All right, just a couple more questions here. This is one that I think a lot of people are dealing with even more this year around working from home. So if somebody is working from their house, can a percentage of, say, their internet costs or the amount of space in their house, maybe a portion of their rent or some of those things, can those be included in operating expenses?
Yeah, so especially with today's conversation where we're talking about cash flow management, that answer is absolutely yes. Where there's a little more detail that you're going to need to find out from a tax authority is taxes. So not all of that can be included as a business expense, reducing your taxable income.
Okay.
But when we're talking about making sure that you're bringing in enough money to pay for the things that you need to keep running the business, to keep living your life, you need to include those things. So yes, it's just a question of where are you including them, and there is place to include that as cash outflow rather than an operating expense. But I'll also just say, in general, 50% of those kind of mixed use expenses is typically not a problem. Doesn't often raise flags, but there are much more detailed equations where you can find out, gas mileage, how much you can include as a business expense, how much per square foot you can include in your apartment. But there's a bunch of different considerations there for taxes. You're probably going to want to talk to a tax preparer about.
Okay, yeah, that makes a lot of sense. All right, and where, sort of on that same theme of where certain expenses would go, where would you put payroll costs? Are those operating expenses?
That's a great question. So it depends what your payroll is for. So what you'll see, even on the IRS Schedule C, breakdown between of your profit and loss, your cost of goods sold will have one line that says production labor. So if you're paying for labor based on how many sales you're making, maybe you're only hiring someone because you have some volume of sales to do, and you're going to, based on that volume, going to pay them some number of hours. That's cost of goods sold labor. That's direct labor, variable labor. Whereas if you're paying for administrative, back end support, things that are not directly tied to sales, right? Maybe you're paying a full-time salary, whether you make 0 sales in a week or 1,000 sales in a week. Those would be fixed costs because they're, again, not tied to the number of sales.
Got it. That makes sense. All right, we just have one or two more questions here. So somebody's wondering if you can review the steps to figure out the cost of the kitchen. I think when you were talking about using like a rental commercial kitchen or an incubator kitchen, um, it's based on the amount of time that you use it. Is that correct?
Exactly. So it's kind of the same way that we just talked about that variable labor. The question is, what is the number of units or sales you can produce in, let's say, an hour? So if, so I do have that in this little gray box here, how we did the commercial kitchen. Not sure if it's hidden. There you go. So if you go to a commercial kitchen and you're paying by hour, then you need to figure out how many sales you can essentially produce for in that hour. So if it's 50 sales, then you're dividing the $20 by 50 sales. And that's the same exact thing if you're paying for a $20 an hour wage for production staff. You would take that $20 an hour wage and figure out how many units they can produce in that hour.
All right. That makes a lot of sense. Okay. And then just one last question before we go, because I know we're a little over time and appreciate so much this thorough information. And I mean, it's clear that everybody who's joined us has really learned a lot today. Do you have any sort of favorite resources or best in class kind of places that you could point folks who are interested in learning a little bit more?
So, I mean, there's a ton of other templates also available on Score's website. They work directly with the SBA. I think people have very, varied experiences with a number of different agencies or organizations. So you can try them out, especially if they have free resources you can download or view. There's a ton out there. I would say the biggest thing is about figuring out what you actually need, right? If you just start pulling resources based on someone telling you this is a small business resource, a lot of it's going to go in one ear and out the other. You need to identify what your next steps are, and then you can do specific searches. You can reach out directly to Start Small, Think Big if you think we can help. Even if we can't bring you on as a full-time client, we will try to point you in the right direction in terms of resources. It really does depend what you're looking for, though.
Yeah, absolutely. That's what I was going to say is I would point folks to Start Small, Think Big, to the templates that you all have, to these kinds of slides that really break it down in such a way that's easy to understand these complex issues. So thank you so much, Ian, for walking us through all of this. And thank you to everybody who's joined us today. We're really pleased to have everybody involved and so appreciative for having this information available. So we will see you at our next couple of webinars. Hope that you've had a chance to sign up for those in the chat links there. And thank you for joining. We'll see you next time.
Thank you all.